In this lecture, we will continue our discussion of how to apply overhead to the units that a factory produces. We will also discuss activity-based costing. We will first continue the discussion regarding the application of manufacturing overhead that we started in our third lecture. In our last lecture, we said that at the end of a period, a company closes out the balance in its manufacturing overhead account and places the amount of over-applied or under-applied overhead in cost of goods sold. We explained that if the amount applied to the units produced was short by $10,000, then the amount passing through the work in process account would be $10,000 short. Similarly, if the company finished work on all of its units, then the amount passing through finished goods would also be $10,000 short. Finally, if the company sold all of its finished units, then the amount in cost of goods sold is $10,000 short. The company transfers the amount of over-applied or under-applied overhead to the cost of goods sold account because the $10,000 mistake ends up in that account, and the transfer corrects this mistake. If, however, some of the units are not finished, then the amount of overhead in those units is short. Similarly, if some of the units are not sold, then the amount of overhead in those units is also short. Under those circumstances, if you wanted to be very accurate, some of the under-applied overhead really should be placed in work in process and finished goods, as well as cost of goods sold. The amount of over-applied or under-applied overhead is called the manufacturing overhead variance. If the amount of the variance is immaterial, then the company still places the entire manufacturing overhead variance in cost of goods sold even though some of its units may be unfinished or unsold. If the amount of the manufacturing overhead variance is material, then the company may have to place some of the variance into work in process and finished goods, as well as cost of goods sold. A test question will specify whether the manufacturing overhead variance is material or immaterial. What is the journal entry if the variance is material? Assume that a company's manufacturing overhead is $100,000 under-applied, and the variance is material. The first thing that you should do is debit or credit the manufacturing overhead account in order to eliminate the balance in that account. In this case, because the account has a debit balance, you need to credit it for $100,000 in order to zero out the account. If the variance was immaterial, you would complete the journal entry by debiting cost of goods sold. Here, however, we are assuming that the variance is material, so you would complete the journal entry by debiting work in process, finished goods, and cost of goods sold. Assume that a company's manufacturing overhead is $100,000 over-applied, and the variance is material. You need to debit the manufacturing overhead account for $100,000 in order to zero out the account, and you then need to credit work in process, finished goods and cost of goods sold to complete the journal entry. Now we need to discuss how you divide the manufacturing overhead variance between work in process, finished goods and cost of goods sold. There are two main ways that the manufacturing overhead variance is allocated to work in process, finished goods, and cost of goods sold. You either look at the ending balance in each of those accounts, or you look at the amount of overhead that is left in each of those accounts. The calculations used in each method are exactly the same. You take the amount of whatever it is that you are looking at for each account and add them up. You then divide the total into the amount contained in each account. That gives you three percentages that add up to 100%. You divide up the manufacturing overhead variance using those percentages. If you were looking at the ending balance of each of the accounts, you would divide the ending balance in an account by the total ending balances of all three accounts. This tells you the percentage of the total ending balances that belongs to a particular account. We will call this percentage the account's relative ending balance. If you were looking at the amount of overhead contained in each of the accounts, you would divide the amount of overhead in an account by the total overhead contained in all three accounts. This tells you the percentage of all of the overhead applied that ended up in a particular account. We will call this percentage the account's relative overhead applied. Let's do an example using ending balances. Assume that a firm's manufacturing overhead is $100,000 over applied, and the variance is material. Also assume that the balance in the finished goods account is $300,000, the balance in the work in process account is $200,000, and the balance in the cost of goods sold account is $500,000. Keep in mind that you would do exactly the same thing if instead, you were given the amount of overhead contained in those accounts. You would first add up the ending balances of each of the three accounts, which gives you $1 million. You would then divide the ending balance of each account by $1 million, which would give you three percentages that add up to 100%. These percentages are work in process, 20%, finished goods, 30%, and cost of goods sold, 50%. You would then allocate the manufacturing overhead variance, which is $100,000, among those three accounts using those percentages. So, you would give work in process $20,000, finished goods, $30,000 and cost of goods sold, $50,000. You would create your journal entry by first debiting the manufacturing overhead account for $100,000 in order to zero out that account. You would then complete the journal entry by crediting the three accounts for the amounts that you just calculated. We are now going to continue our discussion regarding how to apply overhead to the units produced by a factory. Last time we said that if a company used normal costing, it would calculate a predetermined overhead rate at the start of the year, and then apply its overhead using that rate for the entire year. The discussion assumed that you calculated one rate for the entire firm. Many firms do this. They calculate one rate for the entire firm, and this works well for them, especially if the goods that they manufacture are similar and require the same type of work. When the products that a firm produces are different, when those products used are manufactured in different parts of the factory, and when the cost to run the different parts of the factory varies, the use of one predetermined overhead rate may not accurately reflect the amount of overhead that is expended on each product. If a firm does not accurately allocate a factory's overhead to the products that the factory produces, then the factory doesn't really know how much it costs to produce a product. The fact that a firm doesn't really know what it costs to make a product can cause major problems for that firm. For example, the firm may think that it makes a large profit from selling a product when it is actually making a small profit or losing money from selling that product. As a result of that misconception, the firm goes after business that it should be avoiding. Similarly, not knowing how much a product costs may cause a firm to mistakenly charge a price that doesn't produce a reasonable profit on that product. Moreover, when a firm doesn't know what it costs to make a product, a firm may make products that are not profitable because the firm thinks that the products are profitable, or the firm may drop profitable products because the firm thinks that the products do not produce adequate profits. A firm may be able to increase the accuracy of its allocation of overhead to the products it produces by dividing the factory into subgroups and having each subgroup allocate the cost of the subgroup to the products that are produced by that subgroup. The increased accuracy comes from the fact that each subgroup can use different cost drivers to allocate the overhead. It also comes from matching the costs of the more expensive parts of the factory with the products that are produced by those expensive processes. Similarly, it avoids burdening the products that don't require those expensive processes with the cost of running those expensive parts of the factory. One way that the firm can divide the factory into subgroups is to divide the factory into departments, and have each department allocate its overhead to the products that it works on. When you use separate departmental overhead rates, each department calculates its own predetermined overhead rate using whichever cost driver is most appropriate for that allocation. The department then applies overhead using that rate. Assume that a company produces trophies. It makes standard trophies like World's Greatest Parent. It also makes custom-designed trophies that are unique to each customer. Assume that the firm divides its factory into two departments. One department is the manufacturing department that produces the trophies, and the other department is the design department that creates the designs that are used to make the custom trophies. The standard models use standard designs and do not use the design department. Assume that the overhead for the entire factory is $500,000. The overhead for the design department is $90,000, and the overhead cost for the manufacturing department is $410,000. Assume that the entire factory uses 100,000 direct labor hours, the design department uses 10,000 direct labor hours and the manufacturing department uses 90,000 direct labor hours. Assume that the factory currently applies overhead using one predetermined overhead rate for the entire factory. The firm calculated the predetermined overhead rate of $5 per direct labor hour by dividing $500,000 of overhead costs by 100,000 direct labor hours. The firm recently had to give an estimate for two different customers. Job 1 is a custom trophy that will use 20 direct labor hours in the design department and an additional 20 direct labor hours in the manufacturing department. On the other hand, Job 2 is a standard trophy that will only require 20 direct labor hours in the manufacturing department. Using the single plant-wide predetermined overhead rate of $5 per direct labor hour, the firm estimated that Job 1 should be allocated $200 of overhead, and that Job 2 should be allocated $100 of overhead. Using those overhead figures, the firm gave each customer an estimate. The customer who asked for the standard trophy declined to order the trophy and said that he could get a better price from one of the firm's competitors. The customer who asked for the custom trophy placed an order for the trophy and wondered how the firm could charge such a low price. Because of the different reactions to the firm's offers, the firm decided to see what would have happened had the firm used different predetermined overhead rates for each of the factory's departments. When the firm calculated the application rate for the design department, it divided the design department's overhead costs of $90,000 by the design department's 10,000 direct labor hours to get a department overhead rate of $9 per direct labor hour. When the firm calculated the application rate for the manufacturing department, it divided the manufacturing department's overhead costs of $410,000 by the manufacturing department's 90,000 direct labor hours to get a department overhead rate of $4.55 per direct labor hour. Once the firm saw the different departmental overhead application rates, it realized that using a plant-wide rate was allocating overhead to its products inaccurately. Unique trophies were charged $5 per direct labor hour for overhead that was costing the firm $9 per direct labor hour to provide. Similarly, standard trophies were being charged $5 per direct labor hour for overhead that was only costing the firm $4.55 per direct labor hour to provide. As can be seen from the customer's reaction to the firm's estimates, the firm was losing standard model contracts, and although it was getting custom model contracts, the firm wasn't charging enough for those trophies because it thought that the overhead costs were lower than they really were. If the firm had used separate departmental predetermined overhead rates, then Job 1 would have been allocated $271 of overhead, and Job 2 would have been allocated $91 of overhead. When you compare the original estimates using one plant-wide application rate with the revised estimates using separate departmental application rates, you can see that the firm should have charged an extra $71 to Job 1. Similarly, the firm charged $9 more than it should have for Job 2. We are now going to discuss another way that a firm can divide its factory into subgroups that separately apply overhead to the units produced by the factory. This method is called activity-based costing. With activity-based costing, you divide the factory up by activities rather than departments. In order to see the difference, think of a college that has 5 different departments: accountancy, marketing, finance, information systems and management/HRM. If such a college divided itself up by activities, it would use such activities as administering exams, making photocopies, and giving lectures. These activities are not subdivisions of the departments. They are a different way of dividing the college, and the activities transcend the departments. Every department gives tests, makes copies and gives lectures. A factory's activities can include such things as performing engineering work, planning production, purchasing materials, receiving and handling materials, managing production, setting up machinery, storing finished products, and shipping those products. The mechanics of activity-based costing are the same as using separate departmental application rates. First, you calculate the application rate for each activity. You then apply the activity's cost using the appropriate driver. Remember that each activity can use a different driver. There are 2 major disadvantages for using activity-based costing. First, there is a lot of record keeping. You have to keep track of the costs of each of the activities, and you have to also keep track of all of the drivers used by those activities. Second, people resist using it. A firm's workers are probably unfamiliar with it, and therefore complain about having to learn something new. If the firm is regulated by a government agency, the agency may not be familiar with it and insist that the firm not use it when preparing reports for the agency. Similarly, a firm may have a contract with a government or another company where the firm is paid its costs plus a profit. When that is the case, the government or company may insist that activity-based costing must not be used to report the firm's costs. Because of the foregoing, activity-based costing is not used much. The major advantage for using activity-based costing is that it allocates a firm's overhead very accurately. It also provides insight into how costs are incurred within the factory and therefore may help to make the factory more cost-effective. For example, a firm may see that it spends $400 for each order that it ships. This may encourage the firm to try to minimize the number of shipments in order to save costs. Although activity-based costing is designed to allocate overhead costs to units, the cost of the activities can also include labor costs. You still do the same procedures described before. When labor costs are added to overhead costs, the combined costs are referred to as conversion costs. Let's do an example. Assume that a company makes 3 products: the quality product, the superior product and the superb product. Right now, the firm applies conversion costs using one plant-wide rate with direct labor hours as the cost driver. The firm is considering using activity-based costing. The firm can divide its operations into 6 activities. The first activity is material handling, which costs $258,400 to perform. The driver for this activity will be the number of parts contained in the product produced. The second activity is production scheduling, which costs $114,000 to perform. The driver for this activity will be the number of production orders used by the product produced. The third activity is setting up machinery for production runs, which costs $160,000 to perform. The driver for this activity will be the number of production setups used by the product produced. The fourth activity is machinery maintenance, which costs $3,510,000 to perform. The driver for this activity will be the number of machine hours spent in making the product in question. The fifth activity is finishing a product, which costs $1,092,000 to perform. The driver for this activity will be the number of direct labor hours spent in making the product in question. The sixth activity is packaging and shipping, which costs $190,000 to perform. The driver for this activity will be the number of orders shipped containing the product produced. The following information relates to the cost drivers being used. The firm plans on producing 10,000 units of the quality product, 5,000 units of the superior product and 800 units of the superb product. The firm plans on producing a total of 15,800 units. Each unit of the quality product has 30 parts. Each unit of the superior product has 50 parts, and each unit of the superb product has 120 parts. If 10,000 quality units are made, then the entire line of the quality product has 30,000 parts. If 5,000 superior units are made, then the entire line of the superior product has 250,000 parts. If 800 superb units are made, then the entire line of the superb product has 96,000 parts. The total number of parts used on all 3 products is 646,000 parts. It takes 300 production orders to make the entire quality line of products. It takes 70 production orders to make the entire superior line of products. It takes 200 production orders to make all of the superb units. The production of all of the products requires 570 production orders. It takes 100 production setups to make the entire quality line of products. It takes 50 production setups to make the entire superior line of products. It takes 50 production setups to make all of the superb units. The production of all of the products requires 200 production setups. It takes 7 machine hours to make each unit of the quality product. It takes 7 machine hours to make each unit of the superior product, and it takes 15 machine hours to make each unit of the superb product. If 10,000 quality units are made, then the entire line of the quality product needs 70,000 machine hours. If 5,000 superior units are made, then the entire line of the superior product requires 35,000 machine hours. If 800 superb units are made, then the entire line of the superb product requires 12,000 machine hours. The total number of machine hours needed to make all of the units produced by the firm is 117,000 machine hours. The entire quality line of products requires 1,000 shipments. The entire superior line of products requires 2,000 shipments, and the entire line of superior products requires 800 shipments. All of the products produced require a total of 3,800 shipments. It takes 2 direct labor hours to make each unit of the quality product. It takes 5 direct labor hours to make each unit of the superior product, and it takes 12 direct labor hours to make each unit of the superb product. If 10,000 quality units are made, then the entire line of the quality product needs 20,000 direct labor hours. If 5,000 superior units are made, then the entire line of the superior product requires 25,000 direct labor hours. If 800 superb units are made, then the entire line of the superb product requires 9,600 direct labor hours. The total number of direct labor hours needed to make all of the units produced by the firm is 54,600 direct labor hours. You now use the information provided to calculate the application rates for each activity. You need to divide the estimated cost of each activity by the estimated driver for that activity. For material handling, you need to divide the estimated cost of $258,400 by the estimated number of total parts, which is 646,000. This gives you the application rate of 40 cents per part. For production scheduling, you need to divide the estimated cost of $114,000 by the estimated number of production orders, which is 570. This gives you the application rate of $200 per production order. For setups, you need to divide the estimated cost of $160,000 by the estimated number of production setups, which is 200. This gives you the application rate of $800 per production setup. For machinery maintenance, you need to divide the estimated cost of $3,510,000 by the estimated number of machine hours, which is 117,000. This gives you the application rate of $30 per machine hour. For finishing, you need to divide the estimated cost of $1,092,000 by the estimated number of direct labor hours, which is 54,600. This gives you the application rate of $20 per direct labor hour. For packaging and shipping, you need to divide the estimated cost of $190,000 by the estimated number of orders shipped, which is 3,800. This gives you the application rate of $50 per order shipped. The firm wants to know how much conversion costs would be applied to each product using activity-based costing and compare that to the conversion costs that would be applied to each product using one plant-wide application rate using direct labor hours as the driver. In order to figure out the amount of conversion costs that would be applied to each product using activity-based costing, you should calculate the total conversion costs that would be applied to an entire product line and then divide by the number of units in the product line. We will now calculate the conversion costs applied to all of the quality units, and then divide that total by 10,000 quality units. The material handling costs applied to all of the quality units are 40 cents per part times 300,000 parts, which is $120,000. The production scheduling costs applied to all of the quality units are $200 per production order times 300 production orders, which is $60,000. The setup costs applied to all of the quality units are $800 per production setup times 100 setups, which is $80,000. The machinery maintenance costs applied to all of the quality units are $30 per machine hour times 70,000 machine hours, which is $2,100,000. The packaging and shipping costs applied to all of the quality units are $50 per order shipped times 1,000 orders shipped, which is $50,000. The finishing costs applied to all of the quality units are $20 per direct labor hour times 20,000 direct labor hours, which is $400,000. The total conversion costs applied to all of the quality items is $2,810,000, and when you divide that figure by the 10,000 quality units, you get a conversion cost of $281 per quality unit. We will now calculate the conversion costs applied to all of the superior units, and then divide that total by 5,000 superior units. The material handling costs applied to all of the superior units are 40 cents per part times 250,000 parts, which is $100,000. The production scheduling costs applied to all of the superior units are $200 per production order times 70 production orders, which is $14,000. The setup costs applied to all of the superior units are $800 per production setup times 50 setups, which is $40,000. The machinery maintenance costs applied to all of the superior units are $30 per machine hour times 35,000 machine hours, which is $1,050,000. The packaging and shipping costs applied to all of the superior units are $50 per order shipped times 2,000 orders shipped, which is $100,000. The finishing costs applied to all of the superior units are $20 per direct labor hour times 25,000 direct labor hours, which is $500,000. The total conversion costs applied to all of the superior items is $1,804,000, and when you divide that figure by the 5,000 superior units, you get a conversion cost of $360.80 per superior unit. We will now calculate the conversion costs applied to all of the superb units, and then divide that total by 800 superb units. The material handling costs applied to all of the superb units are 40 cents per part times 96,000 parts, which is $38,400. The production scheduling costs applied to all of the superb units are $200 per production order times 200 production orders, which is $40,000. The setup costs applied to all of the superb units are $800 per production setup times 50 setups, which is $40,000. The machinery maintenance costs applied to all of the superb units are $30 per machine hour times 12,000 machine hours, which is $360,000. The packaging and shipping costs applied to all of the superb units are $50 per order shipped times 800 orders shipped, which is $40,000. The finishing costs applied to all of the superb units are $20 per direct labor hour times 9,600 direct labor hours, which is $192,000. The total conversion costs applied to all of the superb items is $710,400, and when you divide that figure by the 800 superb units, you get a conversion cost of $888 per superb unit. When the firm applies conversion costs to the units produced using one plant-wide application rate based on direct labor hours, it needs to divide its estimated conversion costs of $5,324,400 by its estimated number of direct labor hours, which is 54,600. This gives you an application rate of $97.52 per direct labor hour. The conversion costs applied to one quality unit using a single plant-wide rate of $97.52 per direct labor hour is $195.04. This is $85.96 lower than the conversion costs applied using activity-based costing. This suggests that the firm thinks that the quality items cost less than they actually cost, which may explain why the firm sells so many of them. For example, the firm may price them less than it should because the firm doesn't know what it costs to make those units. The conversion costs applied to one superior unit using a single plant-wide rate of $97.52 per direct labor hour is $487.60. This is $126.80 higher than the conversion costs applied using activity-based costing. This suggests that the firm thinks that the superior items cost more than they actually cost, which may explain why the firm sells fewer of these products. For example, the firm may price them higher than it should because the firm doesn't know what it costs to make those units. The conversion costs applied to one superb unit using a single plant-wide rate of $97.52 per direct labor hour is $1,170.24. This is $282.24 higher than the conversion costs applied using activity-based costing. This suggests that the firm thinks that the superb items cost a lot more than they actually cost, which may explain why the firm sells so few of these products. For example, the firm may price them much higher than it should because the firm doesn't know what it costs to make those units. The end.